Welcome to the Banking with Life podcast. I'm your host, James Neathery, and I'm excited to share with you that we've created a new series. This is a topical series where we've taken previously recorded clips, compiled them by topic, idea, and particular concepts within the infinite banking footprint and the financial world broadly. Topics will include loans, loan repayments, paid up additions riders, other riders, dividends, long-term thinking, what could go wrong, what does go wrong within the infinite banking footprint. And I hope you enjoy listening. And it was created for your edification. Thank you. What is a PUA? A PUA is a paid up additions. It is a rider to a policy. So in the infinite banking world, you have a whole life policy called a base policy most often. And then you have riders on top of that, right? Added riders, whatever you and your practitioner have decided is best for you and your family. It could be term riders. There could be other riders, other insured riders, disability riders. There's tons of other riders that can potentially be added to a whole life policy. The paid up additions is a rider. And when you pay a premium to the paid up additions, the majority of the premium goes to cash value immediately. It purchases some amount of paid up death benefit. So there's no future premiums due on that additional death benefit. It's paid up, and it's an additional, in addition to your cash values on your base policy, and it is a rider. So you should probably, young man, read Nelson's Becoming Your Own Banker. There's links in this Q&A how to purchase that and where to purchase that. And then while you're spending money, you should purchase his second book, Building Your Warehouse of Wealth. All right, and then until you've read those two books, you don't know what you need to know, what you should know about the infinite banking concept. Let me say I've talked about all I want to about premium ratio splits, premium dollars allocated to the base whole life policy, and compared to the premium dollars allocated to the paid up additions rider. And then there's a term component in there as well. However, I keep talking about it because it's wrong to start from that basis. You know, you hear properly structured policy, properly structured. Well, what does that mean? Right? Everybody, it's a very broad term. And I spoke about this in the client-only event that we just had in October 2022. Of course, it's client-only, and that content will be made available to our clients only. But I talked about that. It wasn't my whole talk, but the connection was made to Nelson's work. What did Nelson do in Becoming Your Own Banker? Is there anywhere in the book that he says, a base should be this amount and a PUA should be that amount, right? He didn't start there. In a properly designed policy for an individual should not begin from that basis. It should begin from your individual, your personal cash flows, your income, your expenses, your net worth, your debt service, and then your current financial position. And then that should also be considered with your personal financial needs. Do you have a family? Do you have young children? Do you have minor children? Do you have special needs children? Is everybody healthy? Right. And then duration. And this is always left out, or it's rarely considered. I don't see it where it's considered typically. The duration, if you're 20, your time period, your life expectancy is much longer than a guy that's 50. And it's even longer than a guy who's 70. And the lady who is 60, her life expectancy is theoretically longer than the gentleman that's age 60. And so my point here is duration matters, right? So your personal financial position, where you're at right now, what you're trying to do, what you're actually doing, your duration, how much income do you have, how much money can you save, how much money can be allocated toward a premium without right, going to get a HELOC or without doing some esoteric, additional thing to create premium dollars. And I'm not saying that you can't go get a HELOC and use a HELOC. I'm not saying that, but where should a properly designed policy, where should that begin? What is the basis of that structure, right? Well, your financial position, your current position, your future expected position, and I know the future is unknown, and your duration. That is how, from that information, is how you design a properly designed policy. Now, specifically talking or answering your question on a 90-10, 90% to the PUA, 10% to the base. If you flip those and had 90% to the base and 10% to the PUA, depends on your duration, how old you are, right? And then the premium amount. You're going to wind up with a higher cash value in the early years, no question, on a 90% PUA versus a 10% PUA, right? And actually you'll wind up with a higher cash value over the whole duration. Okay. If you have 90% to the base, 10% to the PUA compared to 10% to the base, 90% to the PUA. All right. But what happens in the future on those policies that you have a huge PUA? You can say, well, nothing. The illustration says everything's going to be great. Yeah, that illustration is a snapshot, a point in time, right then when it's printed. And as soon as that illustration is printed, it's wrong. Okay, so there's a lot of things that happen in the future. Some you know, and most you don't know. But when it comes to policy structure, it's pretty it's an educated. I don't even want to say an educated guess. You add fragility to a policy with the more PUA you add and the more term riders that you add. So, but what happens strictly on a 90-10, 10% to the base compared to a 90% base and a 10% PUA, you're going to have more cash value on that higher PUA amount. All right. And comparatively. Now, if you look at a 60-40, a 50-50, or an 80-20, it really depends on your duration, the amount of premium that you're paying. And then, can you even pay a long premium? Can you pay 30 years of premium on a 90-10 policy? Yeah, maybe not. And then the more you vary, the more you vary your premium up and down, the more fragility is added. So I hope that answers your question. The right ratio is for an individual depends on the individual and those circumstances. Then the companies are all a little bit different. Their products are a little bit different. But in my opinion, in my experience, the younger you are, the higher the base premium you should pay. The older you are, it would be a higher PUA. But rarely have I ever seen a case, and I stand to be corrected, all you IBC wannabe noisemakers, go ahead and show me a 90-10 policy that you've owned for 10 or 15 years. Please. Oh, you can't? Oh, okay. Well, in 10 or 15 years, then show me. Okay. And then also the outcome of a 60% going to the base, 40% going to the PUA. And let me too say that premium is premium. If you write a check to the life insurance company, it's a premium. There's not a base premium and then a PUA cash value or cash or whatever the terminology that is misused out in the big wide world. If you write a check to the life insurance company, it's either premium or a loan repayment, period. So both the PUA and the base pay or dividends, and they both accumulate cash value. Okay. And I've said it before and I'll say it again. The base has all the power, or the PUA has all the power in the early years, and the base premium is the most powerful in the latter years. I know it's a blanket statement, but it's true. Let me recap some of this. There is, in Nelson's book, Becoming Your Own Banker, which he would not have put illustrations in if he were to redo the book before he graduated, but he did because of the confusion that it adds. All right. But in all of the policies that he illustrated, there were two components to the policy. There was a base premium. a base whole life premium. I'm buying whole life insurance. And he either used paid up to age 65 or paid to 100, typically. Okay. No, actually. Okay. There was no term riders on there. And I don't believe it. I know that blended PUAs did not exist at the time. And he was full aware of a blended PUA and how they were constructed before he graduated. Okay. And he still wouldn't have used them, my opinion. Okay. Now and the book was printed in 2000. Interest rates have come down. Dividends have come down. Here we are in 2020. And I don't know when the blended PUA riders were created, but they were created by the life insurance company to accept unequal premium cash flows. Okay. And it's really, they're like, oh, this infinite banking concept, some of them, not all of them, but it's like, oh yeah, we should come up with a blended PUA rider. So you could put $1 gazillion in year one and $500 million in year two and the policy not met. Okay. All right. So across the industry, the PUA riders have different names, and we're talking specifically originally the PUA rider had no term component to it. So you mentioned it was a pure paid up additions rider. Okay. So now the industry has created these blended PUA riders, and there's really almost a different variation for each company. All right. Okay. So the premium is paid. There's a cost to that rider, and it's an expense charge because it buys some death benefit, and then the net premium goes to cash value. So every PUA rider has an expense charge, and they're not always fully and clearly disclosed, easily accessible to the consumer. Some of them are as high as 14%.
Yeah.
All right. And now some of the blended PUA riders, they buy, you're buying like a set death benefit, like $1 million in term, as an example.
Okay, so the blended PUA term rider blends a pure PUA rider with a term rider, together, in the same rider,
blended. Why is this even done? Right, because there's a relationship between the premium, the cash value, and the death benefit.
Yeah.
The IRS, and we've talked about this, has looked at life insurance in the late '80s and said, "Oh my gosh," in collusion with Wall Street and the term promoters, said that whole life insurance is a tax loophole for the rich, because the bond promoters couldn't compete with, at that time, single premium life insurance. Wall Street couldn't compete, and the term promoters couldn't compete. And oh my gosh, Congress is always looking for somebody else's money because they don't have any money. So this is a tax loophole for the rich. So they limited what you can pay in life insurance premium. And then they created this relationship between the premium cash value and the death benefit. And if you exceed these limits, then it becomes a modified endowment contract, a MEC in the industry, which just changes the tax treatment of life insurance. And we can have a whole episode on the tax treatment of life insurance. Is it a tax benefit? Is it appropriately taxed? Or is it a loophole? Or is it a tax break? Is it a tax scheme? And oh my gosh, life insurance predates the Internal Revenue Code. It is not an exception to the Internal Revenue Code. An exception to the Internal Revenue Code is a qualified retirement plan. Life insurance predates that. Okay. And then life insurance is not an investment. It is a replacement of a loss. If you go wreck your car tomorrow and you get a claim check, are you going to have to pay taxes on that claim check? No. It's like, oh my gosh, the greed of government has no bounds. You want a high premium and a high cash value without becoming a modified endowment contract, which requires an increased death benefit.
Right.
All right. This is very intentional. The blended PUA, right? You either, if you pay the premium, it internally buys the death benefit. And some of them, use the PUA dividend to pay for that term. Okay. So, I mean, if you think these things through, but what does it do? What is it, they were created by the life insurance companies. There's nothing in Nelson Nash's book that was created by the life insurance companies except for the life insurance product that he used to demonstrate how you could become your own banker. Right. No. And so most of the policies that Nelson built were not weighted to the PUA because the PUA didn't exist, the PUA rider. Right. Okay. My point being is the life insurance companies look and say, oh my gosh, we want some of that infinite banking business. We'll create some of this, blended riders to accept this large premium and internally buy enough death benefit to avoid the MEC. So it makes the first year cash values look very good. The term has a cost, and you bought that ability. You paid for that ability to front load that policy. Mm-hmm. And in some cases, it could absolutely work. I'm going to sell a business next year for $1 million, and then I'm going to be broke every year after that. You can make a case for a blended PUA rider. Okay. I'm just saying, and you can really make a case for anything. Okay. Now, if the death benefit is 1 year term that goes up and it's going to be paid for with a non-guaranteed dividend, I mean, don't you feel like you're a little bit being manipulated? But let's continue on that. It looks like if I did that, if I bought a blended PUA, a policy with a blended PUA rider, I can illustrate and have a very high first year cash value, right? And it looks very good. But whenever you use this relationship of the MEC, there's a initial 7-pay test, the modified endowment contract, this premium death benefit cash value, right? And there's a big long formula, 7702 in the Internal Revenue Code, which I'm not going to get into. I mean, I'm like, my conveyance is a relationship. And there's the initial 7-pay test, and then there's a rolling MEC test. Every year, internally, these life insurance companies are MEC testing. Okay. And so the further out you go on these Frankenstein policies, and I spoke about these Frankenstein policies into a room full of advisors, and God, I love you for being there, being present and listening, but I want you to know, and I've talked to many of you since then, not many, but a lot of you, I'm on the stage talking to a room full of advisors, and they look like a deer in the headlights. Like they did not know what I was talking about. Yeah. And which pains me somewhat, which was, I took those feelings and I wrapped them up and I included them in my last presentation at the Nelson Nash Think Tank. And I'm admonishing in a gentle, loving way, but encouraging the practitioners to increase their level of knowledge and understanding. Okay. All right. When the further out you go, those policies have MEC issues. Why would they have a MEC issue? Why would there be a MEC issue? Right? Because this internal rolling 7-pay test, you're buying a high death benefit with term riders. And the whole idea, it's almost like universal life, right? In which all you agents that listen to this podcast, I'm not interested in your love of universal life. God bless you. Keep learning, okay? And that's in love, sincerely, right? If you want an illustration that illustrates the best without mecking, without any problems, the universal life illustration is going to look the best. Right, the second best is going to be these contorted Frankenstein policies, right? And there's a result, an end result of all of these variations, these machinations, right, that are violating everything that Nelson taught and stood for. And the problems are going to be future problems, probably at a point in time when you can't correct it, right, or have no desire to correct it. And some of the problems can be tragic. I'm talking about taxable events in future years. There's no way that these policies are going to produce an income and a death benefit. I don't care what you say. And even in my talk in Nashville or Birmingham, I asked if there were any actuaries in the room, right? There were some home office people in the room, but I asked specifically if there were any actuaries as I'm going through this. Of course, there was none. But not one home office person could dispute what I was saying, because what I was saying and what we're saying is factual and true. Okay. I can go on, but my point being is the internal rate of return does not go up on those illustrations. Even if they performed as illustrated, which they cannot, they're going to MEC in the future after the 7th year, after the 10th year, in the 11th year and beyond. And we talk about this all the time, because all of these videos that are popping up on my left, your right, a lot of them talk about all of these variations: universal life, 90-10, pay 7 and no more, pay 4. And my encouragement is to, educate yourself, read Nelson's work. I was on Medicare when I applied and was accepted for my current life insurance policy. If I get out of Medicare, will that have any bearing on my current life insurance policy? And the answer is no. Whatever you do, if you own a life insurance policy you don't own, you're applying for it, has no bearing on your health insurance. And you really began the question, if I get out of Medicare, look, Medicare is an age-based benefit. You have a birthday at age 65 in America today, you're going on Medicare. So I would enjoy proper counsel before you opt out of Medicare. Okay. I don't think that would necessarily be a good idea. Okay. I bought $4,000 to $5,000 in PUA. So I paid $4,000 to $5,000 in PUA premium so far, and I have about $5,000 left that I can pay in PUA premium. My understanding is that this goes toward death benefit and the cash value. Okay, PUA, paid up additions rider. So when you pay a premium, a paid up additions rider premium, and let me be clear, when you write a check or send money to the life insurance company, it is all either premium or loan repayment. Okay. And then within the infinite banking footprint, of course, the PUA, the paid up additions, is a rider that allows early cash value. That's why it's used in the infinite banking footprint. Then if you have a mutual policy or a policy issued by a mutual company, the dividend can be paid into the paid up additions as well. So this individual has paid $4,000 to $5,000 in PUA premium so far, has about $5,000 left ability, right? He has $5,000 additional premium dollars that he could pay to the PUA. And I know I'm being repetitive. His understanding is that, does that go to the death benefit and the cash value? And the short answer is yes, right? Paid up additions. So the paid up additions is the additional death benefit that's paid up with that one premium payment. All right. And so all PUA, excluding the dividend, if the dividend is out, applied, paid to the paid up additions rider, there's typically no fee on that. With a paid up additions premium that you write a check for and send to the company, they all have a PUA charge, right? So net of that charge, the net premium buys paid up death benefit, and the remainder goes straight to the cash value component of that rider. So the short answer is yes. And, I talk about this several times, several different locations. And it kind of gets into the structure. You should know your policy, the one that you own or the one that you're considering purchasing. You should understand the dynamics, what you can do and what you cannot do with a paid up additions rider. And then if you don't pay that PUA premium in a given year that you have the contractual right to pay, if you don't pay that, what happens if you don't? Typically, the PUA ability to pay future PUA premiums goes down. It'll be after a time period, 1 year, 2 years, or 3 years. My encouragement is for you to know your policy and you understand the riders of your policy and how they work and how they affect you and what you do or what you don't do. This gentleman says, "Hi, James. I watched your YouTube video on how you finance your truck, and I have a question. You said that you put $30,000 into your life insurance policy as premium, and I did. And then you took out a loan to pay for the truck. I did, and my wife has not. The truck's paid for, and the loan's repaid, but my wife never missed a loan repayment. I just want you to know that. Okay, and then parentheses, you were going to pay the $30,000 anyway. So why not go through a policy? That's what I said in the video. I was going to purchase a truck anyway. And frankly, I thought I was going to be buying a
truck, $18,000, $19,000, $20,000. When I called the individual that I purchased the truck from, who's clients and have become friends and been in the pre-owned automobile business many years, third generation. And, he gave me a rundown. He said, well, you can get he asked, number one, what do you want? Ford, Chevrolet, or Dodge? And I said, yes. What do you want to spend? I don't know, 18, 19. And he just basically told me what year model I could buy at what price range. And the top of that price range was $30,000. So that's where the $30,000 came from. Okay, that amount. Okay. He continues. My question is, since you'll want to pay the $30,000 loan back, quote unquote, don't steal the peas, then didn't you actually just pay $60,000 for your $30,000 truck? Question mark. I'm enjoying learning all about the real infinite banking concept from real NNI sources. Well, I really appreciate the email and the opportunity to answer the question. And I was just speaking with the AV ninjas right before we turned the camera on. I think we have about 5 or 6 modules in the Learning Center and probably, 5 or 6 more on the drawing board. But some of those modules are very old, and this one as well. I think I purchased that truck in 2014. Here it is, 2024. So that's 10 years old. And so we just had a conversation about going back and doing a commentary on some of those modules, which I want to do. But directly to your question, didn't you actually just pay $60,000 for your $30,000 truck? And the answer is emphatically no. I wound up paying $18,000 for the truck. Okay. If you watch through that video, because I did what Parkinson's law that time. I was willing to pay $30,000 for a truck, but I bought a beautiful truck for $18,000. Okay. But no, I did not. Let's say I paid 30 for the truck and I didn't, but let's say I did. And now I'm repaying a $30,000 loan. Didn't I pay $60,000 for the truck? No, absolutely not. I got the truck, even if I paid $30,000 for it. I have the truck at $30,000. And now I have a loan repayment, all right, because I borrowed. And then I'm even paying additional interest. My wife paid that loan back at 10%, and the company was charging me 5%. Okay. All right. No, I paid $30,000 for the truck with those numbers. I'm repaying a loan for 30. Now let's think this through or consider this. Let's say that you wanted to buy a $30,000 truck, and how are you going to get the $30,000? Are you going to work and save it up over time? Or did you just get a gift, or maybe you already have money, cash all saved up somewhere? You just withdraw it from the bank and go purchase the $30,000 vehicle. The $30,000 is what it cost you for the vehicle. Now, if you have the discipline to replace that money, right, that you withdrew from the savings account, is that paying, and you replace $30,000? You withdrew $30,000 from the bank. You paid $30,000 for the truck. Now you're just replenishing your savings account for $30,000. Would it mean that you paid $60,000 for the truck? No. Right. Let's say that I want to, let's say I want to go buy a new truck, $140,000. I don't know what they cost. They're crazy. And I don't drive $140,000 trucks. Okay. I'm just saying, let's say my wife wanted a $100,000 car. She can drive whatever she wants. I don't care. Okay. And I don't have $100,000 right now. I'm either going to go borrow the $100,000 and make loan repayments from a third-party lender, or I'm going to save up $100,000 so I can pay cash and avoid paying interest. Cash only, Dave Ramsey, don't finance anything. Okay. Well, as soon as I save up the $100,000 and then I go pay cash for the automobile, How much interest am I ever going to earn on that $100,000 in the future? Zero, because it's not in the bank. So the bank's not paying me interest. I get the benefit of the $100,000, seeing my lovely wife happy driving her $100,000 automobile. All right. And then let me ask you this in addition. Is that the last automobile I'm going to drive? Is that the last automobile she's going to drive? How am I going to pay for the next one? Right? If I withdrew the money, bought the automobile, I'm not going to earn any interest on the checking account on that $100,000 or savings account. And if I'm disciplined and I know I'm going to buy a future car or another car in the future, wouldn't I just save up the money and pay cash? I'm either going to save up the money and pay cash, or I'm going to go to the third-party lender. There's an interest equation in both of those examples. If I borrow from the bank, they're going to charge me interest, and they're going to control the loan. All right. If I withdraw money from the savings account, I'm not going to earn any interest on that money ever again. But I do get the enjoyment of the automobile. Now, in that particular policy, and I've answered many questions on that, and it's really kind of why I want to go back and go through that module again. I built that policy as a place to put money in the future. You know, I've been asked many times, well, James, why did you have the ability to put $30,000 in there? Because I had a flexible PUA, paid up additions rider, and I had not paid the PUA premium that year or the previous 2 years. That particular company at that time, I had a contractual right to catch that up. That's all I did. So I put the $30,000. All of that's documented in the video. You know, I show you the check numbers. I show you all of that. And I also always show you the increase in the death benefit by doing that on my wife's policy that will accrue to our children. So I hope that answers your question. No, I only paid $18,000 for the truck. In your example, I only paid $30,000 for the truck. The other $30,000 in the loan repayment is I'm repaying the loan to a policy. That money will be available for me 30 days after I make a payment. So I think we paid that truck off in 4 years. And now there's that $30,000 plus was available to us at the end of the 4 years. And to be quite honest, we bought I guess we've purchased 2 cars since then. We're going to go purchase another one, right? So it's not like that's the last vehicle I'm ever going to purchase. So I hope that answers your question, and I would encourage you to go back and revisit that, okay? But thanks. It was a beautiful question. I love it.
Thank you for joining us on the Banking with Life podcast. If you're watching on YouTube, make sure to like and subscribe and click on that little notification bell. Otherwise, join us on Apple Podcasts and Stitcher for weekly content.